Hello, my name is Greg Mosier, and I'm Dean of the College of Business at the University of Nevada, Reno. And I'm pleased to welcome President Mary Daly of the Federal Reserve Bank of San Francisco to our distinguished international lecture today. And we appreciate all the attendees being here. President Daly will discuss the state of the U.S. economy, including the Fed's response to the pandemic, the role of central banks in playing and addressing climate change and economic inequality, as well as some discussion questions. As President and CEO of the Federal Reserve Bank of San Francisco, President Daly is a participant in the Federal Open Market Committee, where she helps set American monetary policy that promotes a healthy and stable economy. Dr. Daly began her career with the San Francisco Fed in 1996 and has served on the advisory boards of the Congressional Budget Office, the Social Security Administration, the Office of Rehabilitation Research and Training, the Institute of Medicine, and the Library of Congress. I'm pleased to say I had the honor of first meeting Mary almost 10 years ago when she participated in a review of our economics department at the University of Nevada, Reno. She's a very impressive person, and we're in for a real treat in this discussion today. I would like to thank Dr. Mehmet Tosun, Professor of Economics and Director of International Business Programs at the University of Nevada, Reno, who will moderate this event. And I'm going to turn it over to Mehmet now.
Right. Thank you, Greg, for that introduction. And I'll say, a couple sentences about this lecture. So first of all, of course, it's a great pleasure to have President Mary Daly. President Daly has visited us, at least a couple times, maybe more in the past. I wish that we were doing this in person, but of course, this has to be a virtual meeting. But we would love to have her in the future in person in Reno again. This lecture is part of our new Distinguished International Lecture series. And this is actually going to be our first Distinguished International Lecture. So that has another special meaning here, I think. So the lecture is, or the lecture series is part of our new lab initiative called the Nevada Global Business and Economics Lab, or MB Global. And we're of course looking forward to hearing more from President Daly about the economy, the state of the economy, the climate change, inequality, and other issues. So, but of course, let me start by asking about what a lot of people expect to hear about, the COVID-19 and the economy. So we're roughly about 1 year into the pandemic. And we would like to, I guess, know about the state of the U.S. economy in this, let's say, 1 year period.
Sure. Well, let me start by saying how delighted I am to be here and to be the first in the Distinguished Lecture Series. Thank you so much for having me. And it's a pleasure to reconnect with my old friends, if not personally, virtually. So that's a great question about where are we a year after the pandemic. Let's do a retrospective. So it's always important, I think, to start by remembering that we came into the pandemic in a very strong position. The U.S. economy was growing solidly in the 11th year of the longest expansion in U.S. history, really adding workers to the workforce, reducing unemployment, raising labor force participation. So sustained solid expansion that was doing so much for our economy, including just growing the pie in the US so that everybody has more. So this was really good and strong. So we come into the that early 2020, getting my years mixed up. They've gone by so quickly in COVID, but it go into early 2020, and then the pandemic hits. In a week, a month, we eliminate all the job gains that had taken us 10 years to, so painstakingly produce. And that was a huge shock to the US economy. We can think about losses in GDP and business, but I think when you really think of the labor market, over 20 million people immediately unemployed and sidelined, then that's a very large loss, a very big hole, if you will. Of course, we got some traction. We've now got a vaccine. We've seen vaccination rates rise, momentum growing in that place, and the virus is subsiding. You know, we have death rates, caseload rates going down. There are pockets where we remain concerned, and we're not through it yet, but there is light at the end of this tunnel. And so it's a good time to do the look back and say, okay, how large is the remaining hole and how long will it take us to get out of it? So when I think about how large the remaining hole is, I see, you know, around over 8 million people, 10 million jobs really that remain still off. We're not where we need to be. We still have 10 million roughly jobs to get back to not only where we were, but where we should have been if we hadn't had the pandemic. So that's a lot of work to do ahead of us. Now I see the economy rebounding and helping us fill in that hole, but it won't be quick to dig ourselves out and to regain the place where we were. So even though we're going to have rapid rebound, in my opinion, when we get past COVID and we can all go back outside, I mean, who doesn't want to start traveling and being in our lives again? We have to keep our heads to the task at hand. And that is that we need to return every American who wants a job back into the workforce, back into those types of employment situations, see incomes, wages, et cetera, grow, and see us back on this very sustainable, solid path of expansion. But right now, I see us as having a remaining hole. We filled some of it back in. I see the momentum is growing as COVID gets behind us. And we just have to really work to the last mile of getting COVID fully behind us and then getting repositioned to grow rapidly, hopefully by the fall of this year.
Yeah, and we know that the Federal Reserve has been very active during the pandemic. Can you tell us a little bit about the policies, you know, like done by the Fed during the pandemic?
Absolutely. And let me just broaden the question, if I may, that it's so really we have this really large hole that I just described that comes in March of last year. And you know, terrible losses in health and lives and the economy. So how do we find ourselves in a position we are now where I say there's light at the end of the tunnel and there's bright spots? And part of it is the role that the Federal Reserve played, monetary policy, and also Congress played in the CARES Act and other types of stimulus. Well, I wouldn't call it stimulus, I would call it fiscal support, you know, unemployment insurance, the Paycheck Protection Loan Program, et cetera. All of those things coming together to build a bridge for the American people over the virus and get everybody to the other side as best we can so that we could regain economic activity when we get the virus behind us. So think about the Federal Reserve specifically. We immediately lowered the interest rate, our Fed funds rate, to near zero, to the limit of what we can lower it to because of the zero lower bound. And that provides immediate relief for borrowers that you can, and we saw this happen, people can refinance their homes, their home loans, so they have more disposable income to get them through the crisis. They can purchase new homes because we're now suddenly teleworking and people need more space to have the comfort of being able to do that. Businesses could refinance or get loans so that they could keep their employees and continue to produce output. So the interest rate changes we made were essential to helping support the economy during those darkest hours that we were in. And we continue to have those interest rate and low interest rate environments supporting the recovery as we go through it. In addition, we took these, and you can see it's like an alphabet soup of facilities we opened. They all have acronyms. You need to look one of those sports playbooks on your arm where you look at the play and you see the name. But the way I want everyone to think about it is that we lower the interest rate, and that in theory should go like water throughout the entire system and help all markets get the relief that they need, whether it's corporate lending, mortgage lending, consumer borrowing, credit card loan rates, all of those things. But if the financial markets are disrupted, then those interest rate changes we've made, they don't go through. So think of the financial system as the plumbing. And if that infrastructure gets clogged up or it breaks down, then the interest rate changes we make, they can't really go through the economy. And that's exactly what happened last year. Even the backbone of the financial system, the Treasury market, the US Treasury market, suffered from dislocations. And so the Federal Reserve's job as lender of last resort is to go in and make sure that the US economy and the global economy has the liquidity it needs in order to make the trades, make the loans, borrow and lend, and help support the US economy. So we did those things, both the interest rate reductions and then also opening these facilities. You probably heard of some of them, the municipal lending facility, the corporate bond facility, the treasury market. We purchased treasuries. We opened a Main Street lending facility. And one of the most successful was the PPPLF, which is the Paycheck Protection Program lending facility. So Congress appropriated this money, and Treasury and the Board of Governors said, well, the Federal Reserve will help facilitate this through the system. We don't have spending powers, we have lending powers. So you can think of us as helping the backbone of the financial system, ensure that the money that Congress appropriated gets to all the people who need it.
And we still don't know like the permanent damage to the economy in the U.S. and elsewhere, right? So like, well, the pandemic is still going on right now. So what do you think needs to be done in the future to kind of like make sure that there's no long-term damage?
Sure, and I think the real starting point for the answer to that question is one of the reasons that I don't forecast a lot of lasting damage, that sort of permanent scarring, is because of the bold actions that both the Federal Reserve and the fiscal agents took. So the problem was there, a 100-year problem. We haven't had a pandemic since 1918, and both policymaking bodies and state and local governments put everything to it and said, we're just going to go full out, give the support, bold and unprecedented actions to support people during this terrible, terrible time. And that, in my judgment, is part of why we don't forecast lasting or permanent damage on the economy or on individuals, because they got the income they needed, they got the support they needed to ensure that they weren't destitute during this period of time, which can leave a scar outside of the scar of already the pandemic or the injury of the pandemic. But our work is not done. And I think this is your point. We can't stop and say, okay, we're finished, that's it, because over 8 million people remain sidelined. And those individuals, if we don't have a strong and stable economy, if we don't have rapid growth to reabsorb them, then they could be left idle for a long time. And you know what happens if you're out of the labor force for a long time or out of the labor market for a long time, then your skills could depreciate. And that's what traditionally ends up with this idea that there's permanent damage. But right now, I don't see that we have permanent damage. What I see is as employers are opening up their stores and saying, please come and work, and I see hiring signs all over the place, then they're finding people coming to apply for those jobs, re-entering the labor force, re-entering the labor market, and getting the kinds of work and employment opportunities they need. The other big piece to this is that this has left a particular toll on women with children who have exited the labor force in large numbers to go home to take care of their children in homeschooling. So part of it is when we can healthily and safely reopen schools and have people kids go back to school, then those moms and many dads can return to the labor market in full capacity in a way that they can't really right now, because they need to balance these competing interests. Today, they're competing interests of taking care of their children and being at the workplace. So those are some of the barriers we'll need to take down, and we'll need to ensure that we give everybody an opportunity to come back and reach their potential, be fully employed.
Well, speaking of like barriers and some other concerns, I want to kind of like move into this very important issue of climate change. All the travel bans, the business closures, the other restrictions on the economy, like that led to the reduction in the economic activity, also led to a reduction in the fuel consumption, and through that, the greenhouse gas emissions. So, of course, this is likely just a temporary change. You're saying that there's no permanent damage. I mean, if you go back to the same growth path as before, like the climate change, as a problem, it is still there, but it can actually like continue to get worse, right? So regarding the role of the central banks, I mean, kind of like a more general question about the central banks, not just the Fed first. What role should the central banks play in addressing climate change, in the future?
So let me speak about the U.S. central bank, because central banks in general are looking at these issues, but I think it's really important for us to talk about the Federal Reserve and what our role is. So the very first thing I want to say is we are not experts in climate change, nor are we climate scientists. So we're not studying how to mitigate those risks or how to think about that. That's the role of our fiscal policy agents to think about those things for the nation. Our role, though, and this is a really important role, so think of us as having a very narrow remit, but a very important remit. And we would be remiss if we didn't take that part of our job very seriously. So here's what central banks are doing generally and what the Federal Reserve is doing specifically. We aren't climate scientists. We don't influence climate change, but we do absolutely study climate risk. And here's what I mean by that. Extreme weather events are already happening more frequently. You can see this in the data. And when they do, they're leaving a lasting toll. Think of the wildfires in the West, the snowstorms and the loss of electricity in Texas, hurricanes, flooding, all of those things are happening, even extreme heat in the United States or extreme cold in areas ill prepared for it. Those all have an impact. And they have an impact on all three of the core functions that the Federal Reserve is responsible for. Let's start with one that I think is often forgotten, but we're responsible for the payment system. And if you think about natural disasters or extreme weather events, the very first thing, and especially if the electrical grid goes out, the very first thing people turn to is not their debit card or their payments on mobile devices, because those don't always work. They turn to cash. And so we have to make sure that, since we're responsible for where cash is located, how much cash is there, that everybody has what they need, that we're responsible for this pretty large inventory management problem. We have to make sure that people have inventories, that we have resiliency built into the system, that we can get cash to where it's needed, when it's needed, even when these extreme weather events are present. So that's really a part of our core function, and we take that seriously. So we have to study weather, we have to study climate risk, we have to understand what that means for where we put our inventories, so that we can make sure that every American doesn't have to worry, on top of whatever else they might be worrying about, whether there's enough cash and they can get to it. So that's job one. The second part of our core function is the financial system. Along with other regulators and supervisors, we're responsible for a safe and sound banking system and financial system. So understanding climate risk and how that's going to affect the asset valuations that banks use as collateral, or their lending practices, or how that's going to influence whether they are appropriately risk weighting what they've got out in terms of lending. Those are all things that we're responsible for, because it's part of the safety and soundness of the banking system. So we have a group here and across the system that looks specifically at that. How is climate risk affecting asset valuations in the financial sector, and what do we need to do to ensure that our banks and other groups we regulate are well positioned to manage any of those emerging risks. And then the third thing, of course, is monetary policy and the US economy. And there, our remit is to achieve our dual mandate goals of full employment and price stability. And as we can see from when wildfires and other things injure the community, that it has an economic cost. And that economic cost isn't just the immediate cost of the dislocations in those specific communities, but just the general cost of geographic movements and where people could live, and they lose their livelihoods and they have to start over. And so those things are all incredibly important for us to understand. And so that's where we spend our time, is understanding all of those risks, how they affect our core businesses, and ensuring that we're doing our very best to serve every person in the community, that we are, we're public servants, and we have to ensure that we understand the problems that our communities face so that we can be best positioned to use our tools to do our work.
Yeah, I wanted to ask this question also because not many people know that the central banks will be playing a role in the climate change, but they do, as you're saying, right? Now, given the pandemic, do you see, or is there any discussion about anything new regarding the climate change efforts, or any change in the policy that is being discussed?
Well, I think the one, I wouldn't put it as a change in how we're thinking about things or what we're doing. I mean, we are dedicated to looking at emerging issues in our economies and our society and making sure that we're not behind in reacting, but that we're ahead and thinking about them thoughtfully. But one thing I would say that the pandemic has taught us, and it's a hard lesson, but it's a lesson not just for us, but I think for the nation and for the globe, is that these risks are real. I mean, how many of you really thought that a pandemic was possible before we got one? We thought it was behind us. And so thinking about just the way to think about risks and what we have to take account of as we plan for our future so we can ensure that we're well prepared. I mean, I feel like in the United States, we've learned a lot of those lessons, and we're thinking about how to do things better. And that's both true of the fiscal agents, members of Congress, state and local governments, but also the Federal Reserve. The other thing that comes out of this is that we realize we have a lot of superpowers that we didn't know we had. One superpower is we can do so many things virtually that we didn't understand. And so that might affect how businesses are thinking about their climate footprint. So you mentioned this, the carbon usage went way down because we're all home, but I'm sure we're going to go back out and travel. We're going to want to meet up with people. We're going to want to engage with each other. And it's also possible that, and I hear this from my business contacts, I spend a lot of time talking to business leaders in the district and elsewhere. And what they're saying is, we learned that I don't have to fly across the country for a 1-hour meeting because I can really make it a good exchange on a virtual environment. And that's good for my health. It's good for, this is what they're saying, it's good for my health, it's good for my budget, but it's also really good for our climate. And so I just see businesses making decisions that are more holistic and trying to accomplish multiple goals that are good for their employees, good for their business, and ultimately good for the climate.
Yeah, great. So another very important issue, or set of issues, inequality and racial injustice, have been key topics for some time, not just because of the pandemic, but with the pandemic we've been hearing a lot more. So there has been this discussion about a K-shaped economy during the pandemic, and the rich is getting richer and the poor getting poorer, so rising inequality. So what is the Fed doing to address economic inequality?
Sure. So the first thing to say is that these are longstanding problems, right? What the pandemic's done is it didn't create these problems, but it put a gigantic magnifying glass on the economy. And really two things emerged that were always there, but we could see them clearly. Thing one is that we live in a society where there are inequities in access to healthcare, inequities in access to education or jobs, or even a safe environment. And those inequities were very apparent in the pandemic. The other thing we recognized, I think, as a nation is that we're very interconnected. We were cheering our frontline health workers, our grocery clerks. We're really so connected. No matter where we work or what we do, we are connected to the essential workers in our economy. And it's important that we bring these two lessons forward: the inequities in our economy and the importance of the interconnections of all of us. Even though we might have our own job and our own narrow thing, we depend on every other member in our community. So if you look at those two things, and then you ask the question, how does that affect the economy? Because what the Federal Reserve is meant to do is think about the economy along with the other things I mentioned, right? So we're looking through the lens of economic growth, economic stability, economic prosperity. Then we ask the question, how are inequities affecting, it all went dark for a moment. I'm sitting so still in delivering my remarks that the lights go out. So there we go. So but we have to ask the question, how are these inequities bridling our growth? And what the Federal Reserve is interested in is thinking about that. And there's research going on. I was a part of a research paper that looked at how much do these gaps between African Americans and whites, Latinx communities and whites, men and women, rural and urban areas, how much do gaps in access to opportunities or jobs or education, how much do they cost our economy each and every year? And it's really over the last 30 years between $2 and $3 trillion a year. So if you want to just put some context there, that's more money in a given year that we just leave on the table in our growth than some of the bills being debated in Congress about infrastructure or relief. So it's a really sizable amount of money, and that matters for our economic output. And so we study those types of things, and that's one of the roles we play, is to just understand the economic impact of anything we're doing, and then what we could be doing to alter that. And then that's where the fiscal agents come in. The fiscal agents are responsible for, because those are our elected officials, and they're responsible for making spending and allocation decisions that we as a society would like to have. And so I see Congress thinking about those issues, and have been for a long time. And I continue to have confidence they'll continue along those lines. But that still brings us back to the following question, and the one you asked me, which is, what can the Federal Reserve do? So we study, we think about this, and we are responsible for promoting a healthy economy, for achieving full employment and price stability. And this is where the piece of our work is really essential. Go back to prior to COVID. There was an 11-year expansion. We didn't complete the full 11 years, but we were in the longest expansion in US history. And that sustained solid growth brought people back into the labor force who had been sidelined and forgotten, really. Some of them tagged as never being able to work because they didn't have the skills or the experience or whatever it was. And yet employers, faced with tightening labor markets, gave them a second look and found that they were actually very productive, easily trained, available to come into the workforce and participate. And that's the key lesson, that if we do our work, that's what we do directly. We support a strong and healthy economy, a stable expansion. And in that stable expansion, these gaps between those who have had less historically than others, they start to narrow. And that's the role that the Federal Reserve plays in making sure that we're doing our part, along with the fiscal agents. And I would offer every one of us in our communities, whether you're working at a university or in a private sector business, everyone has a role to play to make sure the community thrives around us. Because when one of us does better, everyone does better.
Right. You already mentioned, of course, but like regarding the racial injustice. So anything specific you can mention that you are doing like to target that, because that's of course a big issue right now in the American society.
So one of the things that is true is that while we have a blunt set of instruments, we have the monetary policy, we have supervision and regulation, and we have the payment system, right? So in those core functions, I mentioned what we do in monetary policy. We make sure there's a strong and stable economy. In financial supervision and regulation, we have been, maybe some of you have heard of it, but there is something that we're working on right now actively called the Community Reinvestment Act. It's been with us for a long time, but it's up for modernization. It's making sure that financial institutions have the incentives and the ability to invest in communities that have been left behind, and thinking about how to do that well is something that's very important to us. The other thing that's important out of the, and it learned it before, but out of the pandemic, it came to be really spotlighted, is that we need to really ensure that we're doing our part to have access to financial instruments. How are people getting access to the payment system, to financial instruments, so that they can get what they need when they need it? And cash is not the only option, of course. There's this idea of how do you help people get access to financial institutions or lending or saving vehicles. So those are all important roles. And then, of course, there's the other piece, which is in San Francisco, I run a business. I'm a CEO of an organization that's 1,800 employees. So like any business in the community, our job is to make sure that we have hiring practices that promote equity and produce equity, that we are engaged in our work in an equitable fashion, that we are engaged with our community. We're ultimately public servants. We serve the members of our community, that we're out in dialogue with them, asking what are their views on our policies more generally, but what are their views on how the economy works for them, and then bringing that back. And so I see those as our main vehicles for working on these racial equity issues, equity more generally. I think not only of racial and ethnic equity, but gender equity, equity between rural and urban communities, equity between the zip codes you're born in just born in different socioeconomic classes or from different countries. How do we create an equitable society? How do we participate in that ourselves? And so that's how we're doing it. We're doing it from our business line. We're doing it by engaging in our community. And as a Federal Reserve System, we're doing it by fulfilling the duties that Congress gave us on our core function of the payment system, the financial system, and monetary policy.
All right, and I'll say, how about the intergenerational equity, right? So, and this will be my final question before we turn to a question from the audience. So, and this is something that, I have done some research in the past, like going all the way back to my dissertation research in Syracuse. And as you know, like Syracuse had a big program in population aging. So the pandemic, of course, especially at the early part of the pandemic, the elderly population was impacted pretty badly, right? So the nursing homes, and of course, like a lot of it was driven by like failures in our health system, and to some extent, of course, the policies, right? So I think moving forward, and this is nothing new, like not just like specific to pandemic. We had an aging population, an aging workforce for quite some time. So like industrialized nations, developed economies, they've been in a way struggling with that. But of course, like, the pandemic also, I think, brought up this issue as like, hey, we need to basically pay close attention to the well-being of the elderly and gaps between the young and the old. So my question would be about what do you think about the macro implications of the aging workforce and more broadly population aging? And I'm particularly curious about like, what is the Fed's position or like, what is Fed's policies, regarding like, addressing the aging workforce and the impact on the labor market, but also more broadly, the impact on the economy coming from the aging.
Yeah, so I think it's useful at this juncture also to talk about, because you've said it a couple of times, and it's a common way for people to speak about us, that we have a position on things. And it's really not, when you think of the Federal Reserve, we are not taking positions on particular things. What we are students of the economy that we are given, because we're always doing two things simultaneously. We're working with the economy we have and building for the economy that we want, that Congress has said, hey, these are the two things we'd like you to try to achieve: full employment and price stability. And now by achieving those goals, you'll deliver the economy that we all want. So that's how we think about our work. And in thinking about that work, then our job, whether it's talking about the aging population or climate or inequity, is always to evaluate the economy we have so that we can ensure that we can achieve our goals. So the aging of the population is one that's been something that we've been studying for a long time, back in my days at Syracuse as well, getting my PhD. So, but how do we think about that? Well, the aging population, for those of you who are students of economics in particular, but for everyone else, it's interesting as well. The aging of the population is one of the reasons that global growth is slowing, because every industrialized nation, and many that aren't, their emerging nations, have an aging population. And as people age, they work less, they retire, they work just less in a given day. And so that means fewer workers to put towards creating output. They also save more and demand less, consume less, because they're not part of the an aging workforce. As you get older, you just consume less, you're not going to work, you just spend less, and you save more because you're trying to fund yourself through the rest of your life. So those factors are contributing to slower global growth, a lower real rate of interest across the globe. And so that's why interest rates are often going to be constrained by the zero lower bound. It's the combination of an aging population and slower productivity growth that have just left us with these two things that the Federal Reserve really has to think about, not offsetting, but dealing with. I mean, one of the reasons we released a new framework in August of last year We did a big framework review. We had Fed Listens where we went across the country listening to people about how they think about our policies. And then we created a framework that adjusts to this new environment we face, which is this lower growth, slower growth, and lower real interest rates, where this zero lower bound is going to be more of a constraint. And those all grew out of this aging population. So we work on it from that perspective because it affects the aggregate economy, but you also raise these distributional issues about, what are the intergenerational, are there winners and losers across the generations? And what I think we are seeing emerge from those discussions is that healthcare that works for a group of people that's negatively affected works for everyone. And so the pandemic has just put, again, a spotlight or a magnifying glass, depending on your interest in the metaphor, on the issues of our healthcare system we can improve, the issues of our intergenerational equity we can improve. I think of this as we are a society, we are a nation competing globally, and making sure that our older population is well cared for and our younger population. I mean, the two populations most affected in the pandemic, if you really want to put in the age distribution, are the elderly, who were facing all the health risks from the pandemic itself, and the younger population, who went from being able to interact at school, participate, to now being homeschooling, and we don't have a completely good digital system for every young person in the United States. And it's harder to learn sometimes. For many people, it's harder to learn at home on a Zoom. I know I get tired of Zooming sometimes. So I think of that as how we're going to come out of this pandemic. We're going to make sure that both of those groups are given what they need to fully integrate back into our society and our economy.
Yeah, that's a great point about how about the young, right? So there are challenges there as well, and maybe you heard about this research by Acemoğlu and Restrepo looking at the automation that is happening may actually ease some of the economic challenges, economic problems coming from the aging of the population, but it's I don't know, there's probably more research needed on that one. All right, so I want to give some time for questions from the audience. So we want to go for another 15 minutes or so, and we have a lot. so I'm going to moderate the Q&A as well. So we have so let's see. I don't think that I'll be able to go through all of them. So we have about 14 questions here. So one very good thing that I see here is that it's a lot of it coming from students and our faculty, of course, too. So I'm going to start with the first one that was submitted. So this is from one of my students. His name is Josh Rennie. He's doing his MBA. With the anticipated rapid return to growth you're describing, do you, the Federal Reserve or the FOMC, still anticipate 10-year inflation projections at or below 2%?
Sure. So let me speak for myself here, because again, the FOMC, maybe I'll just take 1 minute to say that the FOMC is really it's a great example of good public discourse, right? What you want out of your policymakers, because we all come in with our own, we're studying our economies, we're thinking about our districts, or if they're the Board of Governors, they're thinking about all the data. And then we come in and we have active discussions and debate, so that we're a heterogeneous group of people all looking through different lenses based on where we're living, how we came up, what kind of background we've had. And I see this as just the real benefit of the FOMC. And so, but when I speak, I don't speak for the FOMC, I speak for myself, and I'll tell you how I look at it. And I'm one of many that go around the table trying to work together to make the best policy for everybody. So let me tell you how I think about this is that, inflation certainly has been something that we've been challenged to get up to our 2% target. So in the 10 years that we had that robust expansion, almost 11, we never got inflation up to 2% on a sustained basis. And part of that is just the general issue that I referred to earlier in the answer to the aging of the population question. We just have slower growth. We're constrained by the zero lower bound, and that's not just us, that's central banks everywhere. And so we don't have the normal tools we have to really boost the economy and move inflation back up to our target. It's part of the reason we changed our framework so that we're now committed to averaging 2% inflation. So we've moved to a dynamic or a flexible average inflation targeting program where we're going to say we're going to make up for periods of below target inflation, some, not with a formula, but with just the judgment of what that looks like. We're going to make up for those periods by modestly running inflation above 2% in periods when we have recovery and expansion. And so that's what we're aiming to do as we recover. My own forecast on inflation is that we'll get a temporary pickup in inflation in the summer, and that's really just 12-month moving averages. It's basically, we had some bad readings on inflation 12 months ago. And so when we get some good readings on inflation, there's a pickup, right? The price level, you just get a pickup in that. And so it's going to probably shoot above 2%. Because of those negative readings now combined with these more positive readings. So to shoot up above 2%, but that'll be temporary. And we can't, importantly, get a head fake on that. We just came through March Madness. So if you're basketball fans, we can't get too caught up in that because it's going to be transitory. What we're looking for is a sustained average inflation rate of 2%, not we poke our heads above 2% for 2 months and we call that a victory. So my own forecast is it'll take another year or two to get back up to our 2% target, to get to 2% on a sustained basis, and then to moderately overshoot that for some time. That is going to take a little bit of time. But we've got the time to do that. And in the meantime, we also have this enormous employment shortfall that we also have to reduce and get back down to something that looks closer and exactly like full employment.
Right. On the inflation, a question from one of our faculty members, Federico Guerrero. He's a professor in our department, and maybe you met him during your visit there. So he's wondering about your view of the evidence provided by Alberto Cavallo of the Harvard Business School about the acceleration of inflation in online prices since November 2020.
Sure, there's just a huge amount of academic literature right now being produced about inflation, what's happening with online pricing. Is there sort of it also comes back to, are there supply constraints? The thing that economists worry about and have historically is that supply constraints will boost prices because we've got too much demand chasing too few goods, and then we'll get a pickup in inflation, and that will end up in a sort of a vicious cycle of inflation accelerating. And so I'm aware of that work. I've had many conversations with people about this. The thing that I think is true is a couple of things that I think are worth noting that I'm seeing right now. But again, we're data dependent, so we're going to continue to think about this. But here's how I read all the information right now, is that there are supply bottlenecks, and you can see some of these reflected in online pricing. And you can see some of this reflected in spot prices at the port, where if you want to ship something right now, and you're a firm, you want to ship something, you don't have a long-term contract for shipping, you're paying a spot price that's highly elevated relative to the normal price for shipping. And that's because there's lots of people who want to ship and not that many containers to ship in. And so there's a temporary bottleneck. But those things should subside as capacity comes online. Remember, we're in a pandemic. We're not through it yet, not in the nation and certainly not globally. And so we are under the capacity that we have because it's still sidelined from some of the bottlenecks that we have because of COVID. The other thing is that when I think about online and price discovery, basically, I'm going to talk about price discovery. I actually think that what we're going to find is that this is a downward pressure on prices overall, that, there might be these temporary disruptions, but overall, you're just going to see price discovery, which is what you can do on Amazon, pushing the price level down because you now know that you could get it cheaper somewhere else, and you know that pretty readily. So that's the second thing I'll say. And then the third thing will say is that as we worry about inflation, let me just go back and underline and remind, we want a little inflation. Remember that we had a 10-year, almost 11-year expansion, and we couldn't get inflation up to our target. And hitting our target is important. We don't want to end up in the situation that Japan has been in for decades and that Europe finds itself in, which is inflation can't get itself up to target, they can't get it up to target, and inflation expectations come down. And that's another vicious cycle you do not want to see. Because if you get deflationary pressures, then people wait to buy because they think next day, next week, next year, it'll be cheaper.
Great. Like lots of questions, but okay. So another question from a student, from one of my students again. The Fed balance sheet increased by $4 trillion over the last 12 months. What is a sustainable level? How much flexibility is there, should another crisis arise?
Yeah, so you've just asked that, and it's a great question. The classic question of, are we running out of ability because we've got it so much now, and so we won't be able to offset another shock. So the way our balance sheet policy works, we moved to an ample reserves regime in 2019, and in that ample reserves regime, we're going to have a bigger balance sheet than we have had historically, and it's partly what helps us managing at the zero lower bound. So the balance sheet will be larger, but it's really large right now because we've had to go to those lender of last resort activities, which is our job as the provider of liquidity. We've had to put a lot of liquidity into the economy. At some point when it's appropriate, we will stop putting additional liquidity into the economy. Our balance sheet will stop growing as rapidly. Ultimately, we can return the balance sheet to more normal levels, but those normal levels aren't a preset number that we want to talk about. There are really kind of two real constraints on our balance sheet. One is we can't be the only maker in the market, because then we start actually influencing things in a way we don't want to. And the second is that, the optics of the balance sheet, as people like to call them, the tolerance for people thinking that we're not actually influencing the market pricing across the board because we're too large in any of those spaces. But neither of those things right now is binding us. Neither one of those things is constraining us. And so I do feel like we have the tools we need to ensure that we're ready to offset the shock that we have and get us back out of the hole we're in, get us back on a good path. But I would say for sure, don't look at the balance sheet size in the middle of a crisis and think that's the ultimate size of the balance sheet and will always go up. It's not a step function. There is a normalization of policy that takes place, but we're far from that at this point.
Right. So I should have mentioned that we are, of course, broadcasting this in a way worldwide. So we have a few international attendees, right? So this question is coming from a professor in our partner university in Poland, Warsaw School of Economics. Professor Marcin Kotlarski is asking about your advice for the European economies. Well, he says, especially for my country, Poland, but I don't know if you can really comment on that.
Well, I would not want Madame Lagarde to be calling me, telling me that I shouldn't be offering advice to the ECB. But let me talk about it through the lens of and thanks for joining all the way from Poland. But let me talk about just generally what central banks face, and European central banks are not different than the U.S. central bank. That we're facing these structural pressures that we already talked about a bit with slower growth, a lower neutral rate of interest, lower nominal rates, and having some difficulties because of those situations to ensure that we can hit our price stability targets of inflation that we've all set for ourselves. Because central banks across the globe are going to be doing something that we haven't done in a long time, which is we're fighting inflation from below our target, not trying to get it down to our target. And that change that happened over the last decade is just something that all central banks are grappling with. So when you see the policies that central banks are taking on, which is really, we have three basic tools that all central banks seem to be using. And one is the interest rate. The second is the forward guidance, telling people how long you expect to be in these situations. And you see this in the communications across the board. And then finally, the balance sheet policies. And I'm going to leave out negative interest rates and other things, but the balance sheet policies, those are the three main tools in the toolkit. And I see central banks across the globe using them to fight off the worst of the pandemic and just think about the downturns. I mean, I think the one piece that's different in Europe than in the US right now is that we've been able to, through our framework review, really return inflation expectations to the anchor we want them to be at, which is this 2% anchor. And in Europe, there's still some edging down of inflation expectations, and inflation expectations are critical. They're what determines how much policy space you have in the end, and they're also what determines how stable inflation is, both to positive shocks and negative shocks to the economy. So I'll stop short of offering that as advice, but that's an explanation, I think, for what both the central banks in Europe and ECB and the United States are doing.
Sure, great. A question, and then I'm going to combine a few, because there are so many. This is actually coming from one of our professors, Anaka IER. So she's an assistant professor in our department. She joined us this year, so our most recent hire, I should say. So Anaka is asking about the innovations in financial instruments that happened post-COVID that you think are here to stay. And then a couple other people also asked about hey, what do you think about the cryptocurrencies? So
Yes.
I'll maybe just add that to that question too.
Okay, so so I'm going to bundle all this up into something that I am used to that I talk about a lot, and that is, so what did we learn from COVID? What have we learned from just living on the West Coast and having all of these fintechs providing? And what did we, and what does this mean for digital currency and other things? So let me start with financial inclusion, really. So the very most important thing, the foundation, is that financial inclusion, having people have access to a rapid payment system, to an exchange, to being able to get a PPP loan because they have a relationship with a financial institution that can offer one. These are all incredibly important things. And as you saw from just unemployment insurance distribution, if you don't have a really good system for getting money to people, and you have to mail checks or you have to sign up for things, it's just, these are cumbersome. And so I think we'll learn a lot about just how to intermediate payments from the government to individuals and institutions, and then what role financial services plays in that. So that's important. The second thing that I certainly have taken away, so I spend a lot of time, as I said, talking to business leaders, but also to community members, and importantly to non-depository institutions who serve communities of need, basically. And I hear they're often this term small dollar lending. So how do people get small amounts of money to fund their small businesses or fund themselves through situations? And what I learned there is they're using these payment systems that you're all familiar with, Square and other companies that offer these lending products. They're really offering a payments product, and then they offer a lending product. And so thinking hard about how to get those service flow, those service providers better integrated into the financial system so that the Federal Reserve, other financial institutions, financial regulators can work with them and help them intermediate through the community. We spent a lot of time talking about banking the unbanked. And what I found in the pandemic was a lot of them don't use banks for financial services, but they use these other entities for financial services. So maybe the light bulb really is that instead of always trying to get people to specific banks, maybe we should think about there's a portfolio of services, and how do we ensure all of those services have access to the right financial rails. So those are questions that don't have easy answers, and certainly I'm not the decision maker in those, but you asked for lessons I've learned, that those are the kinds of things I think we should be studying. So now on to cryptocurrency, digital currency. This is a thing that I think if I could leave you with nothing else in this debate or this discussion on currency, cryptocurrency, I'd like to make a distinction. So it's a kind of a misnomer, cryptocurrency, because a currency by definition has to grow with the economy. A currency needs to, so people think of Bitcoin all the time. Bitcoin's an asset. It's got a fixed amount. It goes up and down in value depending on how many people want to use it. That's not a payments mechanism, really. You can use it for payments, of course, but it's not something you could use and scale for the population. So that's why the payment system, and having, if we were going to offer in the Federal Reserve a digital currency, it would have the properties of expanding as the economy expands and not having its value change because more people wanted to use it. So those are not good properties of a currency. They're, in fact, they're faulty properties of a currency. And so I think of Bitcoin and other products like that as assets. They're just another asset. They're a financial asset you can invest in. And a currency, a digital currency, is something that, certainly is being considered. Chair Powell has noted that, we're looking at the pros and cons, the cost and benefits, what's the need case, and what are some of the concerns. And the Boston Fed has partnered with MIT to think about just what are the rails, what would this look like? And of course, the Federal Reserve is also invested in something called FedNow, and that is a real-time gross settlement system, which is basically a payment system that has real-time clearing. And while not a digital currency, it is part of what people want, which is immediate clearing of their exchange. So all of those things are certainly in the making, and they were on our radar and actively thinking about those prior to the pandemic. But I think for the original question, the pandemic really has put a spotlight again. It's a big spotlight on a variety of things on how important financial inclusion is.
All right, I'll do something similar and then combine a few questions, because a number of people ask about the rising public debt. So let me see. Rising public debt, I'm assuming a student also brought up the issue of your take on the student loans. And one of our professors, Professor Mark Pingle, is also, wondering that, well, there's no such thing as free lunch, but we're making an exception, it looks like. So will the US experience a cost related to this large debt that we're incurring right now? So that question, and let's make this the final one because it's almost 11. So
okay. So let me just take on this issue. So the governments, like households, need to save and spend according to their budget. That's just an important component of good fiscal discipline. And we, if you take economics or any kind of public finance, you'll be taught this, and it's right that you can't just spend forever and hope it all works out. That would not be a good decision. But I want to distinguish that from what is happening now. So right now, we had a once in 100-year health crisis, and we would have left millions upon millions of Americans destitute if not for the support that Congress offered. So I applaud Congress for taking those bold actions. I think they have been critical to ensuring that the bridge over the pandemic has been both strong enough and long enough to get Americans, as many as possible, onto the other side and best prepared. So those bold actions, along with the ones we talked about from the Federal Reserve, I think have been just critical to ensuring that we look like we do today, that people are poised to go back in and be active and participate in the economy. So it's, we might not have wanted to spend that. I mean, we didn't want a pandemic, but we needed to. And that's the role that I believe government plays in a society, is you have to do the hard things when the hard things are required. So then the next question, of course, is, well, what about other spending? And here I'd like to make a distinction between spending for consumption and spending for investment. So we can't lump all spending together. That's one of the early lessons of public finance. And if you spend for consumption, then you don't earn a rate of return on that typically. If it's for a bridge over a pandemic, then obviously that's very important and supports the economy. But when we're getting past COVID, we're talking about things like infrastructure, and that's an investment good, not a consumption good. So making appropriate, smart investments that improve our potential output by increasing our productivity, by making sure that that I wrote a speech last year, having roads, bridges, educational infrastructure, health infrastructure, and digital infrastructure. Those are all things that make us globally more competitive and really ensure that down the road, we can have a more productive economy than the one we currently have. And so those are investments. We've got low interest rates right now. Those are investments that pencil out as paying for themselves over a period of time and are distinct from, consumption related spending, which obviously you don't get a rate of return on. So right now, I leave this to Congress. There are elected officials, but when I look at it as an economist and as a policymaker for the Federal Reserve, I see the kinds of discussions we're having and the kinds of aid that they've provided as being very helpful to the economy.
Well, I agree with that. So that's all the time we have. It's exactly 11 a.m. right now. So do you have any final words you want to say in closing?
Well, I'll just say that it was delightful. I really enjoyed this. Great questions. And, you know, the thing that I may want to leave you with as a Federal Reserve official is that Federal Reserve officials, I can speak for my colleagues here, we feel we do our best work when we have dialogues like these, because it's not an ivory tower job. You don't go in a room and close the door. We do go in a room and close the door, but you don't do that without having conversed with people. It's not a job for people who rely on introspection. And I can say with great pride that my colleagues are, and we all are dedicated to being involved in these kinds of discussions. So I appreciate the opportunity, and I look forward to more.
Yeah, thank you, Mary, very much on this. And we will love to have you here again in person in Reno, and then do another one of these in person. Thank you.
I look forward to it.
Yeah. So thanks for joining me in this wonderful conversation. So have a great rest of your day.
Thank you. You too. Be well, everyone.
Thank you.